Here's the truth. Wall Street rarely says, the market doesn't need to be wrong to make you poor. It just needs you confident at the wrong moment. It's December 2nd, 2025, and the US market is open. Grab Holdings Limited, Grab on NASDAQ, trades a bit above $5, valuing it a bit above $20 billion. It looks normal, which is exactly why it's dangerous. This is where investors get hurt. Fundamentals improve just enough to tempt you, while one unexplained move quietly reopens downside you thought was gone. Grab is US listed, but economically Southeast Asian. It operates across Cambodia, Indonesia, Malaysia, Myanmar, the Philippines, Singapore, Thailand, and Vietnam. That matters because you're not modeling one market, you're modeling 8. More moving parts means investors demand higher confidence before paying higher valuation multiples. Multiples, like price to earnings, expand when outcomes become predictable and compress when they don't. Grab reports 4 segments: deliveries, mobility, financial services, and others, but investors should see a single system. Deliveries and mobility are frequency engines. More transactions build habit and retention. Retention lowers customer acquisition cost, or C, what it costs in marketing and incentives to win each user. The superapp logic is simple. Acquire once, monetize many times. Rides, then food, then financial products. Financial services is where the structure can change. This is where take rate can expand. Take rate is the share of gross merchandise value, GMV, that becomes platform revenue. GMV is the total transaction value before Grab takes its cut. If GMV grows but take rate doesn't, monetization is weak. If take rate improves while costs stay controlled, margins can expand, and margins separate a story stock from a durable asset. That's the late 2025 setup. Grab is a negotiation between belief and skepticism. On a trailing basis, revenue is about $3 billion, net income about $100 million, and EPS just a few cents. Yet valuation looks conflicted, a very high trailing PE versus a much lower forward PE. That isn't a quirk. It's the market admitting profits look real, but not proven durable. The key question is whether this is repeatable profitability or a temporary peak from timing, discipline, or a competitive lull. To answer that, we step back. In 2024, Grab posted roughly $3 billion of revenue, up close to 20% year over year, while sharply narrowing losses. After years of subsidy-driven growth, that shift signals improving unit economics. Unit economics means the profit profile of a single ride, a single delivery, or a customer cohort after direct costs and incentives. In mobility and delivery, incentives often decide everything. Incentives are subsidies to consumers, drivers, and merchants. Discounts, bonuses, promotions used to build demand and supply. They can drive growth, but they also create fragility.